Hey guys, this is Alan Moore, certified financial planner and founder of Serenity Financial Consulting. Thanks for joining me. So you want to contribute to a Roth IRA, but you've been told you make too much money, huh? If you made more than $110,000 in adjusted gross income, or $173,000 if you're married for 2010, you can't contribute directly to a Roth IRA because of the income limitations. But you still really want to contribute to a Roth IRA, right? There is a way. It's called Non-Deductible IRA contributions. So non-deductible IRA contributions are essentially contributions that are made into a traditional IRA that you don't take a tax deduction for. So with a traditional IRA, you normally put money in, you take a tax deduction in the current year, the money grows tax deferred, and when you take it out in retirement, it's all taxable at your income rate in retirement. A Roth IRA, on the other hand, allows you to put money in, you pay the taxes when you put it in, no tax deduction, and it grows tax-free. The non-deductible IRA is kind of somewhere in the middle. You don't get to take the tax deduction for your contribution, but the growth is allowed to grow tax deferred, but then you have to pay taxes on the growth in retirement. So you can see if we had a way of turning a non-deductible contribution into a Roth contribution, it would be huge tax savings because essentially you would never have to pay tax on the growth within that account. And you think if you get 6, 7, 8% over per year over the next 30, 40 years until you need that money, that's huge amounts of taxes. So there is a way to do this, and here's what you have to do. Step number 1, open a new traditional IRA. Don't try and use your current one. Step 2, make a non-deductible contribution to this IRA. Maximum is $5,000 for 2012, $6,000 if you are over age 50. Step 3, open a new Roth IRA. Step 4, call your traditional IRA's custodian and say, hey, I want to make a Roth conversion. That's it. You actually won't even have to pay taxes because you didn't take a tax deduction in the first place, so you have basis in the non-deductible traditional IRA contributions, so you don't even have to pay taxes. It's a really cool thing. As recently as 2009, you couldn't do this, but in 2010, they actually dropped the income limitations on Roth conversions. So it's a really cool strategy. But there are a couple things to keep in mind. Number 1, if you're going to do this strategy, wait at least 30 days between making the non-deductible contribution and the conversion. Some experts actually say wait until the next year. The reason is you want to establish a very clear paper trail to show that you did make a non-deductible contribution and then you made the conversion. The second step is be sure you use a new Roth IRA. There is a slight concern among some experts that say that the IRS could call some of these conversions into question. It's not likely, but it is possible. So you don't want to be rolling money into your current Roth IRA because if the conversion gets called into question, it will expose the entire account to basically the ramifications by the IRS, which is to basically say, okay, all of this money is now taxable. You don't want to do that, so be sure you use a new Roth IRA. The final thing is be sure you file Form 8606 with your tax return. Okay, this is the form with your taxes that shows basis in an IRA. So this is your non-deductible contribution. Okay, so the year you make the non-deductible contribution to your IRA, be sure you file Form 8606 to be able to prove that you did make that contribution, because if the IRS ever comes calling and wants proof of the conversion, this is going to be a must-have. All right, so what do you think? Have you ever tried to make a Roth contribution and didn't think you could? What do you think about this strategy? Is it something you're going to try? Definitely feel free to let me know if you have any questions or concerns in the comments section. So that's all I have for today. Thanks so much for joining me.